Alrighty, let's get this started here. Again, just a couple slides here from us. We obviously have had the pleasure of supporting a lot of transactions. Some of them referrals, thanks to Ben, and grateful to you for that. And in other cases, directly working with you, Jim, so grateful for that as well. I think you probably track this pretty closely, Ben, but a lot of private equity activity in the chemicals, more broadly across the board, right? Quite a bit of activity in general. But of course, last few years have been challenging, primarily due to interest rates. But if you look at the chart on the right, there's quite a bit of dry powder that's available to be invested. Jim, you just got some more dry powder, a few $1 billion in this case to invest, but more on the venture capital side. Well, I guess we'll talk a little bit more about that.
It's just a rounding error.
Rounding error. In and around materials, resources, we see, in general, we've seen activities pick up over the years. We've seen deal values as well rise. Of course, in the last couple of years, again, it has been a little bit of a challenging environment. We do a lot of work in and around plastics and polymers. So this is specifically data on plastics and polymers on the right side, where we actually saw a little bit of an uptick in 2023 relative to 2022 in terms of deals. But obviously, we didn't see the kind of peak that we saw in 2021, for example. And a lot of factors here. I'll skip through some of that here. In terms of just some qualitative color on where these transactions are occurring, we are seeing a lot of European chemical companies acquire assets in and around recycling. I think to a certain extent we see similar investments and initiatives even here in the US as well, but we take a European lens here. And then, just building on some other conversation earlier, early stage companies, we are seeing a lot of interest in and around software in general, but we sense some sort of an uptick specifically focused around chemicals and software. So we are getting involved. We do a lot of work in and around digital, but historically that's been around oil and gas. But now it seems like there's quite a bit of activity focused specifically around chemical markets. So with that, let's talk a little bit about each of your companies. Maybe Ben, kick us off here. Tell us a little bit about who Grace Matthews is.
Sure.
And I believe you have a short presentation.
Yeah, I'm going to skip over some, but...
Okay, looks like we don't have it here. Can we pull it in, please?
If not, I know enough to talk about my company.
Okay,
so.
okay. Then maybe Ben, let's get started, and we'll see.
Yeah, I put together a few extra slides before Jim was kind enough to jump on the panel here. I thought this was going to be a panel of one, so I'm like, yikes, I better pull some stuff together. So Ben Scharff with Grace Matthews. Grace Matthews is a middle market investment bank focused exclusively on chemicals and materials. We do, lower middle market. So we work on transactions generally, I would say, for $20 to $300 million in transaction value. We've done things as large as $1 billion, but probably our average deal size is right around $100 million. We'll do 8 to 12 transactions a year. Probably 85% of that is on the sell side, 10% on the buy side, and listening to everyone here today, clearly we need to be doing more capital raising because it seems like there's a big need and a big market for it out there. So we do a little capital raising, fairness opinions, and the like. But effectively, we're kind of a mid-market sell-side M&A firm. And when I think on the sell side, probably historically our clients, a third of them are family-owned businesses. A third are carve-outs of larger public or private chemical companies. And a third are, at least the way we think of it, private equity-owned businesses. I would say most of the deals we work on the sell side, probably 90-95% are the companies headquartered in North America. They may have operations worldwide. Some of the things we may get into, I spent probably about 5 years going over to we get to Europe probably 3-4 times a year just for marketing efforts, but there was about 5 years there where I was going over probably every third week just with some of the projects we had going on. We've got strong relationships with a lot of the big chemical manufacturers over there. trying to picture what the slides were here. So, so my background personally, I've been with the firm since we founded in '99. Two of my partners, John Beagle and Doug Mittman, the two of them, myself and another two individuals, were at a firm that effectively split in half. I went with them. John's got a daughter named Grace. Doug's got a son named Matthew. They didn't want to put their own name on the door, so that's where the name Grace Matthews comes from. Fast forward to today, we've got 19 or 20 folks. Unlike most of the people in the room, I'm not an engineer or have a chemical background by training. I've got more of a finance, economics background, but if you look at our firm, it's heavily populated with chemical engineers, chemistry grads, material science engineers, and other engineering disciplines. We've actually started recruiting a lot from the schools down here in Texas because some of the programs, specifically like Texas A&M, they have a really good chemical engineering program where you tack on a one-year Master of Finance, and so we've got probably three of our younger folks in our organization came out of that. Today we've done well north of 200 chemical transactions. I would say that of those, probably heavily focused on specialty chemicals. I know a lot of the conversation today, it differed a little bit. I see some of the slides here now, but and myself personally, I probably spent a lot of time in paints, coatings, adhesives, lately a lot in lubricants and metalworking fluids. Kind of one interesting project I thought of as I was listening to everyone today. Probably 10 or 12 years ago, KBR took all the kind of disparate technologies within their company and smashed it together into what they call their technology business unit. I worked closely with them for about 2 years, and that was some of the reason I was bouncing over to Europe so frequently at the time, as they were trying to go out and either buy smaller technology businesses, or a lot of the big chemical or petrochemical companies out there had technologies that they may be underutilizing or were on the shelf, and so we were having a lot of those discussions there.
And
so,
if you want to use this.
Yeah, I'm trying to think if there's anything. All right, so we can go through all this. Yeah, so those are our folks. Just looking at, again, just some stats here. Here are some of the recent deals we've worked on. There's probably some logos you guys recognize. One of the ones where, I don't know if Roman is still here, but we just sold Marichem recently, last month, or part of Marichem. They kept their caustic services business. Marichem, they had a process technology business where they were building systems that largely were reducing or removing sulfur from either gas or liquid streams, and these were projects anywhere from a couple $1 million to tens of millions of dollars. The process itself, we thought definitely was going to go to a strategic buyer. As we dug in more and learned more about the business, it was standalone enough to where we said, hey, why don't we include a few private equity groups that have some background in this space. Nice business, good team, good technology, great reputation in the market. Black Bay, I don't know if anyone here knows Black Bay Capital. I've heard our partners mentioned a lot here today. They had really deep expertise and experience in and around sulfur treating. And so we're able to bring a lot of resources to bear to the company and have some pretty cool ideas of how they want to grow that business going forward. So that's one example of a company here locally that we worked with. So again, well, I thought Jim might not be here. I threw together a couple slides that I hope don't contradict with what Uday just went through, more logos. So if anyone here gets our newsletter, and if you don't, happy to get you out a mailing list. So we usually send out a quarterly newsletter on different aspects of the chemical industry. So it might just be a general market update, M&A update. We may pick a specific sector and kind of do a little bit of a deeper dive into that. This is just an index we've been tracking for about 25 years now. This is, I think, just the last 10. But it's about roughly 100 different publicly traded chemical companies. I wish this went back further, because it kind of has been, values have been pretty high for the most part for the last 10 years. I mean, obviously there's some ups and downs there. You see COVID. The market has definitely been strengthening over about the last year and a half, from kind of that 9.0 you see in September of 22. And one of the nice things there is, as the market does better, as companies trade at higher multiples, they tend to feel better about themselves, and they tend to get a little more aggressive from an M&A standpoint. But just one thing I'll point out, if you're looking at this isn't, if you look at public data, usually they'll show PE, PE trading multiples. The way we think in the M&A markets is always, enterprise value over EBITDA. So EBITDA multiples, and enterprise value is effectively kind of the value of the company less cash and debt. So just thought this is always an interesting thing to show. We're sitting right around our 10-year average today, but on a reasonably decent trend line. This is, I think, the same data, just kind of by different market sector. I always find this interesting because, we talked about before, the things that touch your skin tend to trade at high values, and you see the flavor and fragrances here at, they always kind of lead the pack in terms of trading multiples. And I just, I always notice that if you look at, coatings, adhesives, lubricants, again, a lot of these formulated chemicals, they tend to trade higher than their raw material inputs. Distribution has been pretty interesting with some of the dynamics in the market of recent. A lot of the distribution companies performed really well over, go back 6 months, and I'd say the 12 to 18 months prior. So you saw their multiples actually dip because their profits shot up so much that I think the public markets didn't view them as being sustainable. But interesting data nonetheless here. I think those were plastic numbers you were just showing, Uday. This is just something, again, we track, we pull out a Cap IQ, and then we've got a couple other data sources here. This is just deal flow by quarter, since 2018. Obviously, we all know what happened kind of over COVID. Everyone kind of sat on their hands and didn't know what was going to happen in the world. Deal flow shot up, the back half of that year dramatically. And then 2021, I've been doing this for almost 30 years now, and 2021 was by far the busiest market I've ever been involved with by a long shot. I mean, it was, every process you're obviously engaging with a lot of external advisors, be it lawyers, environmental consultants, HR consultants, IT consultants, what have you. And I feel like most of them were charging triple the rates because you just couldn't get time with them to try to get deals done that year. Since 21, things have softened quite a bit, and there's reasons for that I think we'll get into. I think there is a little bit of optimism at present. Part of that's maybe due to the public markets. Part of it is the chart that Uday showed, where there's a lot of dry powder out there with these private equity funds. At the same time, there haven't been a lot of exits by private equity funds over the last 12 to 18 months. So there's a big, I would say, inventory of deals out there. I mean, they get paid to buy and sell companies, so there's a big inventory of deals and transactions out there that we think will start coming to market probably the back half of this year. And I think the last one I had in here, which I think is super interesting and kind of dovetails into what's going into the market right now. And I think we're using 2018 as a baseline here, but this is, basically looking at reported inventory numbers, again, for that kind of that same subset of publicly traded companies. And you see that kind of tick down, through COVID and then shoot up dramatically. I mean, you had COVID, you had the Texas freeze, you had all kinds of logistics and transportation issues, war in Ukraine, all these things where companies all of a sudden, if they could get product, they bought product. And so, part of those numbers I think we saw in 2021 where deal flow was so aggressive and so active is all the companies going to market selling were on such a tremendous upward tick or upward growth trajectory because all of their customers were buying anything that they would produce because everyone was building inventory through that. So that held stable, and now we're seeing, we're hoping it's getting back to normal now, but we're seeing a fair amount of softness in the market, especially with the chemical formulators, just because as people have been running down inventory, they haven't been buying as much. And the world we live in, it's all about sustainability of revenue and profitability and margins, and it's been a little tricky, a little choppy, a little hard to measure those things of recent, just with some of these dynamics going on, I think, in the macro economy. So those are my slides. I went through them quickly because I know we got a full panel here, but
Thank you, Ben.
Give that back
That's
to you, okay.
very helpful. Jim, tell us a little bit about Aramco Ventures, and maybe then also talk a little bit about investments in and around chemicals, materials, which there are plenty of, right?
Yeah, absolutely. Okay. Thank you very much, Uday. We've worked with ADI Analytics quite a bit over the years as well, so I've known Uday for probably a decade now, at least, so appreciate the opportunity. And from an Aramco Ventures perspective, so we are the corporate venture capital arm of Aramco, which is the $2+ trillion company. I saw today that NVIDIA is about the valuation of Aramco after quite a blockbuster earnings report. It's almost shocking. But anyways, so Aramco Ventures has now $7 billion total under management. And as that flows down, there's a few buckets. I'm part of the corporate venture capital group. There's another group called Prosperity 7, which is a diversified technology play, non-energy, and that has $3 billion under management. And then under the corporate venture capital arm, the strategic venturing that I'm involved of, and I head up North America for that, we have $1.5 billion sustainability fund that we're investing for the last year and a half. And we'll do investments. Last year we did one as small as $250,000, and the largest, we did a couple that were $35 million, and we can go up to $75 million in that $1.5 billion fund. So that is very much focused on how to help Aramco achieve the ambition of getting to net zero by 2025 for Scope 1 and Scope 2 emissions. And so technologies to decarbonize Aramco's existing operations, and then looking at lower carbon businesses is really a focus of what we do and what we look at. E-fuels has a role to play in that as well, and so that's very much a focus of what we do. So we try to get a diversified portfolio of technologies that can help get to net zero by 2050. So that is really a focus of what we do. Our stage is agnostic. We can lead, we can follow. Most of our deals, I was laughing when you showed the EBITDA, the enterprise value to EBITDA multiples for 2023. We need you to project out to 2032 and then, in order to value some of these, and say, because we don't see EBITDA till 2032 on a lot of deals, possibly, especially in spaces like SAF and things of that nature. So it's very much long dated, and it's a long game, and it's quite an interesting dynamic as you look at the economics of the energy transition. And that I heard earlier about talking about the green premium, and so that keeps me up at night a lot, figuring out the economics and what we're trying to fight through right now. Some of the deals that we've invested in, you heard Jeff talk earlier, a couple panels before on Numat, and we are investors in Numat, very excited about MOFs, and the Metal Organic Frameworks has been core of what Aramco's been working on and interested in for quite a while now as well. And so I first met Numat more than a decade ago, I think, or maybe a decade ago here in Houston, and came into Aramco, which is quite a unique platform as far as a company that delivers 1 in 10 barrels of oil in the world every day. And so MOFs was part of what we were looking for at that time. Numat's a clear leader in that, so we're very excited to be invested in Numat and MOFs. And really our interest is on the carbon side of the equation, although Numat's doing a lot more in using that platform for different verticals, but that carbon vertical is the one that has the most interest for us as well, to try to figure out some of these technologies that can address DAC, as you were talking about it before. and so that's a good example of one. One of the other ones that we had invested in that I was on the board of was a company called Novomer, which is based out of Rochester, New York, and one of the professors there from Cornell specifically, and that very exciting. We sold that one in the heyday of 2021. That was quite a happy exit. We were glad to find an exit on that, because as you saw, that I was very sad to see the down, like below the trend line in the last couple of years, and I think that I'm glad to hear your optimism of this year.
We're paid to be optimists. I don't know, so hopefully it comes true.
Because it's pretty hard in the capital raising markets today, for sure. But those two, and I'm a geophysicist as well, so it took me 6 months with Novomer to even be able to pronounce beta-propionolactone, right? Let alone explain what it is. But so my geophysics didn't really help in that regard. But I've become much more broad in my knowledge base as I came into Aramco, and the breadth and width of what Aramco is involved in is quite extensive. And the scale of Aramco, that's certainly one of the things that stood out in my mind when I came in. And I realized when I was talking to one of the business units, and they said, "Oh, we have this tail gas treatment problem, with sulfur, and we need to spend $5 or $6 billion to fix it." And I'm thinking, $5 or $6 billion? Like everything with Aramco, you need to add 3 or 4 zeros to put it into context of a lot of others. It's just how big Aramco operates. So a lot of the things that we do, of course, we're investing. If we're investing at seed, we've got to figure out a way to help the companies and to figure out how they can de-risk and get to scale. Because the only way that it's relevant for Aramco is if it's at an enormous scale. So the technology has to get to an enormous scale for it to be relevant. So that's some of the things that we work on up front, is figuring out, okay, it's at lab scale, and we get it to bench scale, and then first of a kind plant, and then can you get it to the level that it can service the broader Aramco. That's our remit, is to take these technologies we're investing in. The goal is to get it adopted in Aramco. And that's also not an easy process. We do have a refinery here in the United States, the biggest one, Motiva, which is wholly owned by Aramco. So that's a fantastic test bed for us locally, close by, for companies that are in the United States or Canada, which we cover, where some of those technologies can be applied and used at Motiva. And Motiva, we found it's a fantastic management team with an innovative culture that they'll try things. The Port Arthur refinery has a lot of space and a lot of processes in which they can test things here. And then if they work here, they can export to the rest of Aramco's ecosystem around the globe, and mostly in Saudi Arabia.
Excellent. Thank you, Jim. Very helpful. Ben, you were talking a little bit about corporate carve-outs, and of course, is it fair to say that at least from our point of view and some of the data that we showed, right, that PE investing has declined a little bit, just given the broader interest rates? First of all, I'd be interested in your thoughts on that. But then second, seems like corporate carve-outs are also another big driver for M&A. I'm curious, what are your thoughts on both of those areas?
Yeah, maybe I'll start with the latter. I mentioned a third, kind of how our deals break down. I would guess over the last 5 years, 40% of what we're doing is corporate carve-outs. Mm-hmm. I actually think that the big strategics have frankly learned from private equity and taken a little bit more of a portfolio approach in terms of how they look internally. You used to have a lot of these companies that just, they would buy, they would never sell, they would buy, maybe it's the active shareholder, whatever, things have changed in the market. I think they have figured out that they need to do a better job of deploying capital effectively. We're having conversations with the big strategics all the time regarding, hey, it may be a very good business, but it's just maybe not core long-term to what the company wants to do. So I feel like the conversations we're having there are much more frequent, much more fruitful, and much more executable in terms of them looking to go and carve out businesses. And so, yeah, I 100% would agree. I think the corporate carve-out thing, and I think that will certainly continue, is my experience. And then on the private equity side, there's a lot of capital out there. They want to do deals, right? Yeah. I feel like we may be insulated a bit there, where we play in kind of the lower middle market, because I think the interest rates, and there was a lot of good presentations and conversation earlier today, so like interest rates, inflation, all those things are clearly impacting the consumer and market demand, so that affects everything. It affects company performance and all that stuff. But I think as it relates to just deal activity, I feel like and there's no bright line here, but you get over maybe $150-200 million, and I think the financing markets, I think the debt markets are starting to loosen up, but they certainly tightened. So it was much more challenging. We did another deal last year in Houston here, and it wasn't announced, but it was roughly 80 million of EBITDA. So it was a pretty decent sized deal. And the buyer, albeit strategic, they had to raise debt, and they had trouble doing it. They eventually did, obviously. We got the deal done. But there's a lot of capital out there. They want to get deals done. I think the financing markets and the interest rates have impacted the larger side of the deal market, the smaller mid-size where we play, less impacted. I think private equity has still been active on the buy side, less on the sell side. And so I saw some stat the other day where if you look over the last 10 years, on average, a private equity fund has bought 2 companies for every 1 company they've sold. And I think part of that's because, this buy and build strategy, right? And that number over the last 12 months is like 2.8 or 2.9 or something like that, and it's kind of trending up. And so, again, those things have to come to market at some point here, so that will have to shift. But I have not seen a change in buyer appetite from private equity. It's just on the sell side, they've been a little more hesitant to take things to market, unless they're really good businesses. Anything that has a bit of a hair on it, a story to it, something, which in the chemical industry, most of those do. They've been kind of sitting on their hands a little bit.
Yeah, so we recently did some piece of work for a client where we were looking at trends of investing in and around PE, and we came to a similar conclusion that there's a pretty large set of companies that are in the portfolios of private equity firms that are somewhat mature and ready to come to market, but are not quite out there. So,
which is nice if you're a strategic buyer. If you lose something to private equity, it's going to come back to market in the next 3, 5, 7 years. So you'll get another chance at it.
Fair point. Jim, what are you seeing in terms of themes for investing in and around energy and materials, right? Or maybe another way is there are lots of early stage companies here, right? What themes would resonate with Aramco, would pique your interest?
Yeah, so the venture capital group, so we're really not focused on Aramco's upstream business, and that's a huge business of Aramco, but our remit is focused on those things that are related to the energy transition or the digital transformation of Aramco as well. So that's some of our themes. But from the sustainability side, you mentioned DAC and SAF, and we're looking at some of those and been engaged with you on some of the investment landscapes as well to go through and understand the technologies that are coming, understand the economics of what they are looking like. I was just on a discussion at Greentown Labs this week. When was that, Monday or Tuesday, I think. Time flies, and talking about hydrogen, and that's very much a focus of what we're doing, looking at hydrogen, looking at creating blue ammonia, shipping that over for power generation in Japan. And so those things are front and center of what we're looking for, those technologies where we can utilize ammonia, or at least some way to create hydrogen, to transport, store hydrogen, all very relevant for what we're looking at.
And sorry, go ahead.
I'd say for so we do less probably in energy transition, but the whole concept of sustainability. I mean, it is a topic of conversation pretty much in every process now that we're running. When you're talking to private equity, they're mindful of it. The strategics are mindful of it. I would say I've seen a lot of situations where people get really creative to kind of fit their business into kind of a sustainable ESG type approach. But it is something, even maybe less energy transition, but the sustainability, circular economy, those things. It is certainly becoming far more relevant in some of the discussion. At the end of the day, I think the buyers are still underwriting kind of that sustainable cash flow going forward. But if your sustainability program kind of aligns with the buyer, it does help maybe get them to stretch a little bit in terms of aggressiveness in a process.
And I will say the CEO of Aramco, when he talks about the energy transition, and it's a $100 trillion global economy that needs to transform with the energy transition, but he said it can't happen without a materials transition as well.
Yeah.
So very much a focus on what we're doing now. More and more is focused on materials.
Yeah, it's interesting because when I was doing the outlook for chemicals today, one of my highlights, one of my insight or key messages was that the megatrend for chemicals is energy and materials transition, right? So that makes sense. Ben, are you seeing, so we did a version of, in the investor panel in one of the prior forums, maybe a couple of years back, we were looking at how some of the larger chemical companies were divesting businesses so that the resulting portfolio has a better sustainability profile, right? It seems like that trend is continuing, right? We are continuing to see businesses that have closer ties to oil and gas, I guess coming on the block or being more likely to have some sort of strategic decision around them.
Yeah, and I think 100% agree. I mean, we're actually working on a process right now with one of the big coatings companies where we're selling a business that I won't say what chemical it's using, but they're looking internally saying, hey, we have to be out of this material. It could be like a PFAS or a lead or something.
Yeah.
Asbestos really isn't out there anymore. But yeah, they're incredibly mindful of kind of how that impacts their public image, and so I think we saw 10, 15 years ago, a lot of the big companies going, hey, let's bifurcate our business and focus on being more specialty and less commodity because those trade at higher values.
Yeah.
But I think you're right. I think today, a lot of that has played itself out. So you have a lot of them that are saying, okay, what within our portfolio is kind of a drag potentially, or a public relation type, problem. If it's, if attention is put on it that we're selling these sort of materials. So, and I would kind of throw that into that whole sustainability ESG bucket that is certainly top of mind.
Who is buying those kinds of businesses? Who's the investor?
Yeah, private equity certainly. Other, sometimes you'll have other strategics who are just kind of buy and build type thing. Mm-hmm. There's actually a lot of value because a lot of times you can buy those businesses as well. It's kind of the last man standing approach where, it's a, not, underappreciated maybe product, market, what have you, which means that a lot of people or no other people are trying to get into the market. So you have a little bit of pricing power there, and it might be something that's just a slow decline, but you can cash flow like crazy and do really well in those sorts of businesses. So there's clearly buyers out there for them. Some buyers won't touch them, but you only need one, right? to ultimately to transact in a process.
So Jim, in the materials, chemicals space, how should companies pitch to Aramco?
So I think as we look at it, we look at the relevance to Aramco. So I think it's very important to understand where it fits within Aramco's ecosystem and kingdom, or maybe here as well, and understand that so the pitch comes in to really hit the key notes that we have. So we're out there looking as well, but when one comes in on an inbound and having that immediate connection of understanding what Aramco's needs are, what they are for like direct lithium extraction or something of that nature. Okay, what is it? What anything that you can find on the internet and do the research to understand what some of our pain points are and problems are that have been out there in SPE papers or wherever it may be in the public domain. Having that knowledge when you come in, that certainly gets one leg up because the first thing that we do is to engage our subject matter experts on the technology and say, what do you think? What does it look? Is this relevant? Does this meet our needs? Is it economically viable for what we do? And that's not always a trivial process to get through.
Mm-hmm. So, but do you find sufficient deal flow, specifically in chemicals, materials, or you think there's opportunity?
Yeah, I think there's opportunity, and we weren't very focused. So SABIC is our sister company that Aramco owns the majority of as well. So SABIC has a lot more, and they have a venture capital arm which is separate from Aramco Ventures venture capital arm. So they operate and invest independently of us. We do send deal flow over to them that's relevant for us, especially in the chemical space, because it might be more relevant for them than it is for Aramco or Aramco Chemicals. But we have to look at that and kind of determine as it comes in. But from the materials side, I think it's growing, and we haven't had a huge focus on it. And with some new energies businesses that are now being established and created, that mandate comes into our group, and it will expand what we're doing. So I expect us to be more active in materials than what we were previously.
Okay, that's great to hear. I'm assuming when you say new mandate, this is the additional.
Some of that's part of so the initial or the additional $4 billion that we got, that is tied into to Aramco's overall strategy and corporate strategy, and new energies being one part of that.
Okay, and you, I just want to confirm this again. I know you mentioned this, but you are investing across a broad range of rounds, right? Seed to all the way to...
up to series, and some of that new bucket of money as well will look at doing investments that are bigger in companies that have matured. It may be raising Series D or Series E, and they need to build a first-of-a-kind plant. And so we talked about this at Greentown Labs at the investor roundtable beforehand, that so project financing is fantastic, and everybody says there's zero technology risk, right? That's like, and everybody wants zero technology risk, and the reality is there really zero technology risk? So when you're building some of these first-of-a-kind plants, getting that project financing is very challenging. So what are those buckets of capital that can help finance these first-of-a-kind plants? And so Aramco has a bucket that can come in with equity on that to hopefully open up some opportunities for additional debt to come in, or some type of project financing, especially for these first-of-a-kind plants, which I guess by definition have a certain element of risk to them.
I think I see a lot of people scribbling notes back here.
Ben, when you look at valuations, right? You showed an interesting chart about destocking, or inventory levels, and it seems like there's considerable destocking that has occurred in the last probably few quarters, right?
Yeah.
And I'm assuming that's a good sign for the chemical industry, right? Because a lot of customers have probably been waiting. Yeah,
we hope we're back to normal now. Then.
Yeah.
Sorry.
No. So what does that do to valuations? Is that an indicator that you look at for valuations, or you are just using that as an indicator for the health of the industry?
Well, I think the impact it's had is it's just created noise in the P&L of companies, right?
Yeah.
So, for buyers, whether it's private equity or a strategic buyer, again, they want to underwrite whatever that sustainable future cash flow is. And when you have a lot of volatility in order patterns, and we live in a month over month, year over year analysis where you're going through a process, and it's like you miss numbers for a month, you get potentially penalized for that. Yeah. But that's hard when you've got a big run-ups of inventory from your customers. They're bleeding it down. Someone's coming in to buy the business, and they're saying, what does this look like 2, 3, 5 years from now? Maybe 10 years from now, I guess in some cases, but typically the ones we're looking at. And so you get a lot more scrutiny through the diligence process. I think pretty much every project we work on now, and this is, it's becoming more of a dynamic, I'd say, over the last 5 years. Obviously buyers would always come in and they have their whole cadre of outside advisors that they're using, one being a financing partner to do some sort of quality of earnings report. Almost every project we take to market now, we're doing a sell side QOV report. So we're being proactive. We're doing a QOV report before we launch to the market.
QOV is quality of earnings.
Sorry, quality of earnings. So they come in, and it's usually an independent third party. They analyze your financials, and it's different than an audit, because they will from an audit perspective, you may be accounting for things properly, but there might be one-time events that are in there. And so you might be able to kind of build in credit for some of this run up down in inventory levels. If you just brought on a new large customer halfway through the year, they might pro forma that back through the whole year. If you had big fluctuations in raw material, but whatever. As greedy investment bankers, we're trying to get credit for as much as we can, right, through that process while it's still, somewhat defensible without going over the top. And so I think all of those things impact kind of thoughts around valuation, what someone will underwrite in terms of, we believe this is what the business looks like. I will say a corollary to all this, with all the noise in the income statements of these companies, the processes we're running, where the valuation range used to be here, it's here, right? Because different buyers will have very different views on the market and what it looks like going forward. And so some of those add backs, and they may say, hey, we think this market, this end market's coming back, automotive's coming back, oil and gas is coming back, construction's coming back. And then some of the things that impacted the performance of your business over the past 12, 24 months, whatever it is, they may give you credit. Well, you'll end up gravitating in the process towards the ones that give you credit because they typically end up putting a higher value on the business. And so it's very interesting, all these kind of, all the noise, and it goes back again to COVID, to the Texas freeze, to all the logistics issue, all these things have just, the financials of most companies just aren't clean over the last 12, 24 months, so.
The old adjusted EBITDA.
Yeah, very adjusted, pro forma, whatever else.
Those things that are one-off that happen once in a century, but actually happen every 2 years.
Yeah, I feel like the number of one-time events is accelerating. But,
That's an interesting one. What is the impact of climate uncertainty on valuations? So one more follow-up question on that, Ben. Like, it feels to us from the outside that the holding period for a lot of companies by private equity firms is increasing. Is that a fair assessment, or we are missing something?
Yeah, no, it definitely is.
And so maybe talk a little bit about why, right?
And I think it's interesting, and I wish some of the data we have here is public data. Getting private comp data is really tough because it's just a lot of it's not reported, and the stuff that is reported, like we'll look at it, and there's deals we'll have worked on, and then you'll see publicly reported data. You're like, it's not even close to being that. So you can't put a lot of stock in that a lot of times. But I have seen some data on just hold periods. And again, I mentioned the thing before about, typically they buy 2 for every 1 they sell, and it's, that's increased. I think the hold period has extended, maybe 18 months over the average. If a hold period is typically 4 years, it's getting close to 6. I'd say an interesting corollary to that is it's a little bit counterintuitive in a soft market, is we've actually seen valuations and transactions hold. And I think part of that is because, not only, but generally it's the good businesses, kind of if you want to rate them A to F or whatever, it's like the A businesses are going to market because they're getting a ton of attention, because you got this whole flight to quality and people are willing to pay up for good businesses. And so then when you look at the transaction data, you go, wow, that's interesting, because valuation multiples have been basically holding over the last 12, 24 months. And I think the ones that are, maybe Bs are as well, but kind of your B minuses and your Cs, I think especially private equity is smart enough to understand this, because they're in the job of buying and selling businesses, right? That they've been holding them, fixing up what they can, and been waiting to take those to market. So I think if you had the same set of companies going out today as you did 2 years ago, I think you would see valuation multiples on average down a little bit. We haven't seen that because the dynamic of better businesses coming to market. But I think they've spent a lot of time fixing the businesses, and like I said before, I think we're going to see a strong influx of private equity-owned businesses coming to market in the back half of the year. I mean, they have to at some point. And I think people, if rates just hold, if they tick down a little, I think you are going to see those coming to market, and it's going to be a pretty frothy environment.
And so it seems like private equity is getting a little bit more patient, but Jim, venture capital is infinitely patient?
We invest a lot in fund of funds as well. So part of our program, we did 5 fund of fund investments last year, and I think previously you'd see the 8 plus 1 plus 1, 8 years plus 1 plus like a 10-year total life with 8 years, and those last 2 plus 1 are optional as well. And you don't see, I think, 8 plus 1 very often anymore, especially focused on the transition. So it's 10 plus 1 plus 1 plus 1 plus 1. You know, involved in one that's, I think, on year 14 at the moment. So it's longer hold periods for sure. And I think you see the byproduct of that is that there's a much more active secondary market. And I think when you think about figuring out how to get liquidity, you may see that class grow in opportunities, even from corporates as well, that maybe the portfolio, some of those are less strategic. So putting it together in a secondary sale package together, you've got to have some good ones with some maybe that are not so good. But I think you'll see that more, especially if the capital markets open up like they were in 2001, that really helps with liquidity for sure. Yeah. But there needs to be the like M&A, and it's been very difficult to find liquidity. And so same thing with corporate venture capitals as well. We don't have a time limited fund, so we don't have to sell like a lot of the private funds where they really have to make something happen. So we don't have that driver. That's, I think, attractive part of corporate venture capital, especially on some of these long dated, like when you're investing in SAF. It's unlikely to be an exit in a couple of years after you get in. You're in the long game.
And how engaged and involved are corporate venture capital groups in running these companies?
Yeah, as far as board activity, so we've invested, I think, 53 companies, and there are 41 still in North America, and there's still 41 that we have in some way, shape, or form. We have board seats on 8 of those 41, and then we have observer seats on, I believe, 27 of them. So we do work at the board level to help influence and understand what's happening and see where we can step in to provide a value add to the board. But so we are active, and a lot of times an observer is as active as a board member. It depends on the board and the dynamics. But so we try to be active and add value.
And I would just add, I mean, we've seen this across the chemical space where a lot of, maybe not the size of Aramco's fund, but a lot of the big chemical players out there, whether it's a distinct fund or kind of a de facto fund, but a lot of them have over the last 5-10 years created these kind of internal venture capital funds where they want to have kind of their pulse on new technologies out in the market, and it's good for them because they see what's coming. They might be able to sit on the board or have observation rights, but sometimes they then become, if they end up helping commercialize whatever they invested in, a lot of times they then become the de facto buyer of that. If
that's a great point. Actually, on I think it was yesterday on energy transition, we talked a little bit about how there is some sort of a blend that's going on between venture capital getting into a little bit, almost like private equity kind of financing transactions, and PE funds all forming decarbonization, venture capital, large PE funds doing, and so it seems like it's all blending together. Ben, one question for you. A lot of PEs buy firms from other PEs, and I've always struggled to understand that. What's the driver?
Necessity. I mean, at some point, you get things.
But what do those valuations look like?
Yeah, and maybe I'll just take a step back. And when I think about the chemical industry, again, I've been doing this for almost 30 years now. And when I started, there was very little private equity activity in chemicals. I could probably count on, well, maybe not 2 hands, but it was probably a couple dozen I could think of that were really kind of active in the chemical space. 10 years ago, it was probably 100. Now there's probably 400 funds that we interact with fairly frequently out of probably a few thousand in North America, I would guess. So obviously they're paid to do deals, and so now as more and more companies are owned by private equity, like they don't necessarily have a choice. I will say what you typically see is some funds are set up to basically take a company here, right? So if you're a fund that typically invests in companies that have 5 to 10 million of EBITDA, and a lot of times funds will have sectors they invest in, they'll have sizes they invest in, there might be some other criteria in there. Like you kind of take it to there, you know, most of the time a fund will buy a business, they'll invest heavily over the first, say 2 to maybe 3 years, let those investments kind of take hold so that when they go to sell, it's on kind of an upward trajectory from a growth perspective. And so they may have bought a fund or a business that had 7 million of EBITDA, grew it to 15, 20 million. It's typically a different set of funds that then buy those businesses.
It gets to a size where I guess it makes it appealing to a different set of funds.
Yeah, and then certain funds may just have experience in certain spaces or sectors. And I think I don't want to say private equity is a commodity, but it's become a little more commoditized because there are so many private equity funds out there. So they're always looking for ways to how do we differentiate ourselves. And so they may have sector expertise in a few areas. They may have operating partners with expertise in a few areas. And so then when those businesses come to market, they will jump and spend a ton of time on them. Yeah. And I think other funds, if they don't have expertise in those areas, they're a lot faster now to say, hey, this isn't there's a lot of quick no's now when you're reaching out to folks. And they say we don't see an angle to where we can be competitive and win here. And you know, it's just too much time because some of these funds, you know, we were talking to a fund the other day, and I think they had looked at 3,000 opportunities last year. I mean, it's just, and this was in a down market. I mean, and they were kind of a general, so it wasn't just chemicals focused, they were a generalist fund. Yeah. But, you know, the discipline you have to have not to just waste too much time, you know, you got to make decisions quickly as to which ones you're going to pursue, and then you got to pursue them really hard.
Excellent. Let me open this up to questions here from the audience.
And thank you to everyone for staying till the end here.
So I have a question for both. Is when we read finally releases, right, when there's an acquisition or there's a divestiture that happens, there's a lot of ESG talk. So I just wanted to understand if that is something that they write when they release after the acquisition, or is that something that they actively take into consideration while deciding?
I mean, I think it really depends on the fund and the opportunity, right? I mean, funds are, you know, I feel like us investment bankers are shameless marketers of ourselves sometimes. Funds are the same way, right? So if they can buy a business that kind of fits that ESG profile, I mean, they will certainly have that plan in place. They'll market it as they're selling it. I mean, when we just, the Americhem deal, I mean, that was a lot of talk that we recently did, that Black Bay bought that I mentioned. I mean, through that whole process, everyone was talking about how this would fit their ESG strategy, right? And so Black Bay bought it, and I guarantee, you know, when they're talking to their investors or their limited partners who are putting the capital into their fund, that is something that they're spending a lot of time talking about, and then thinking of other ways they can kind of build on that within the organization, because I know when they sell that in 3, 5, 7 years, whatever it is, like that'll be I think a key marketing theme for them, because the attention on that, I have to believe, is only going to grow, you know, as we go forward, not diminish. So I think that's certainly top of mind for them. Okay.
More questions? Well, if not, thank you again to Ben and Jim, and Jim in particular, special thanks for jumping in at the last minute. Ben, of course, you've flown in Houston, but I'm grateful to you as well. Let's give the panel a hand.